As we turn now to the Fed and what's happening with the Fed, and it's interesting because initially the market didn't believe or doubted, the dots, and I always love the dots. I always think of my what my kids would bring home from kindergarten. But when you look at it, it's the market is still not believing that the Fed is going to maintain its current rate and get to about, let's call it 3.75%, 4%. Instead, they think that QT is going to give way to QE sooner. And I disagree with that. Like I think that the Fed is going to get to 4%, pause, and I think they're going to sit there for longer as they try to manage expectations when we're looking at wages, when we look a wage spiral, inflation issues. And the problem with inflation, as we've talked about, it's not just obviously the endless amount of liquidity, but also those supply shortages that are continuing based on aluminum, copper, other key raw materials that even as demand has slowed, because it has, there's still that shortage of supply. So we're not really getting some of those different pieces. So when we look at things going forward, we do believe that the Fed is going to maintain. And again, and the reason why we say that, and we actually think that you'll see 2024 drift higher, is because the stickiness that we're seeing in terms of sticky inflation and inflation in general. And this is just looking at U.S. core PCE in July. Survey was for 4.7, came in at 4.6. Now, we do see an acceleration again in August, and we think that that's going to continue into September. And one of the key things that we talked about in the EIA show is everybody's making a big deal about gasoline, which is true. Gasoline has come down. It's been a great, I think it's like 70 some odd days in a row that it's gone down. But look at diesel. Diesel has now not only stopped going down, it's back up. It's up to 508 or 509 now. And that is the biggest headwind that we see going forward is diesel, because gasoline, you see it, you feel it, you put your credit card in, you know what you're paying. But diesel is, it compounds throughout the supply chain. And when you buy that final product or have that final product delivered to your home, you're paying for diesel the whole way. And that's where we continue to see a lot of pain and a lot of this pressure. Now, you're going to have the benefit of a base effect. If there's 0% increase in price month over month as we get into next year, obviously, the base effect helps because you're going to have a very large denominator when you look at the previous year. But it's just, you're not seeing deflation coming through, and that's where we continue to see some of these shifts. So again, shifts into deflation, which we think is something that's going to happen, let's call it the second half of next year. So the probability of a 75 basis point hike in September is now back to 80%, or close to 80%. And that's really on the back of, again, when you look at jobs numbers are still comfortable for them. You're still seeing some of those pieces that would give them the opportunity to raise rates again at a fairly sizable clip. And as I said before, a few weeks ago, I always thought a 75 basis point increase was likely. Some of the market believed a 50 basis point, but I think we're starting to get that move back up. Now, when you look at financial conditions, again, what's giving them confidence to do it, financial conditions still remain fairly accommodative. And this is using two different, the Oxford Economics, FCI, and the Goldman Sachs financial conditions are both showing that things are still okay. They're still fairly easy. They've tightened, obviously. They're not what they were, but they're also not at the highs, and they're coming into some of the succinct moves, which would allow the Fed to continue to be active. But if they do that again, that's also going to send the dollar higher. That's going to put more pressure on bonds. And now those are some of the things that we've been talking about. So Powell once again reminded the market not to expect a pivot from the U.S. Central Bank at any time. His comments weren't significantly different from what the FOMC minutes. But again, they were still expecting this. And that's why he had to come back out and cool those expectations, because they're not going to pivot. And when you look at the labor market is too tight, the Fed is focused on easing demand, and a recession won't necessarily mean rate cuts. And I think that's the biggest piece, because I think everyone's waiting for the Powell put, where a recession, and I think he tried to come out and meet that and say, look, even if we start and head into a recession, we can't pivot yet. And I think that's the disconnect in the market is, oh, well, recession equals cuts. And my point is, going back to 2021, they waited too long. There was no reason the Q3 of last year, we still should have been doing what we were doing. So that opened us up to some of this pain that we're now going to be through. The question is going to be, how deep is that recession? And I think instead of cutting, you get a pause. And even that would be more hawkish than what the market expects. And that's, I think, some of that disconnect that remains. And then he said, expect economic pain. And those are, I think, some of the key pieces. And I like this chart. I think it's a really strong chart highlighting the problems that they're facing and what they want to avoid. So when you look at what happened in the 70s, where you had this huge increase in inflation, and then it fell off fairly quickly, a lot of that driven to base effect, you started to get cuts. And then you saw this big reacceleration, and they want to avoid the reacceleration that led to the need, whether you agree with it or not, for Volcker to increase rates exponentially. And so that's where I think the market is. It needs to be a better student of history and look at what happened in the past. And again, history doesn't repeat itself, but it rhymes. I know there's differences. I'm not saying they're the same, but I think the lessons learned needs to be, okay, well, I don't want to be Volcker, who Volcker has come out and said he wished he increased a bit slower and paused more along the way, because if he did, they wouldn't have had to get to 22%. They would have been able to stop at about 17% looking back. And I don't think they want to get to that point, and they want to avoid a wage spiral. They want to avoid a lot of these problems, which is going to keep those rates higher for longer. And I think that's the disconnect that is in the market right now, which is where I sit. Whether I'm right or wrong, I leave it to you, the viewer, but I'm just presenting you with the data I see and how I interpret it in ways that they're going to try to manage the market. And here, when you look at government transfers, again, coming back to where is the income going, government assistance continued to fade. Transfer payments as a percentage of personal income at the lowest since the pandemic began, but still above where the pandemic started. So again, there's still some out there, and we'll get a bump as you get the forgiveness for student loans. The moratorium still exists. So again, there's still something that's in there, but it will continue to fall, to get rolled out. Just as personal income only went up 0.2% versus the estimate of 0.6%. And personal spending only went up 0.1% versus the estimate of 0.5%. But now that obviously you see the deceleration, but now think of it from the perspective of, well, where are we in real terms? So real personal consumption expenditures have flatlined. They're falling off the trend and starting to roll. And when you look at where some of the personal spending monthly change, durables still remain elevated. But when you look at gasoline, when you look at groceries, those are some things that slow down. But there's always going to be that disconnect, that back and forth. And if you think about where we were in July, you have back to school, you have a lot of things being prepared. And that's where, as that falls down, we expect that the real personal spending on some of these, like the durables, the furnishings, that will slow, and services still will remain elevated, and we'll continue to see this collapse between the two. And the reason why is when you look at real personal income is still well below the trend line and continuing to move a bit lower. There was a slight pause in the decline, but one of the things that we had said is it's not really going to just collapse. It's going to be a fairly slow rate of change, but negative. It's going to continue to drift lower as wages have slowed, and wages in real terms, and as prices continue to move higher, especially in some of the key sticky demographics that we've been highlighting. And you're seeing it, some of it here when you look at total card spending per household, excluding grocery, clothes, and gas and clothing. Excuse me. By income groups. So credit and debit card spending per household, ex grocery, gas, and clothing for those with annual income above $125,000 has contracted on a month-on-month basis for 3 consecutive months. So that's typically the biggest spender is that grouping. And we're seeing them actually slow down some of their spending. But when you look at any income bracket, excuse me, it continues to slow from May into July. And we see that not so much accelerating more to the downside in August, but really just staying at the negative level. And it's just because, again, what are you going to buy? And this is where you kind of get that fiscal drag. You got all this money, you had all these benefits, you spent the money. So what are you spending it on now? And that's where we're seeing some of that additional slowdown. Now, when we kind of break down the PCE price index, you can see this is what we were talking about on that hit to, well, what is real consumption going to be? Well, yes, you had the benefit of gasoline and other energy goods, which we haven't hit winter yet, so we still haven't picked up heating oil. We still haven't had a mark-to-market on electricity yet. Natural gas is currently at $9.22. Again, coming back to heating. So that energy bucket is going to get a little bit of a bump as we get into October, November, obviously depending on when winter kicks up. But even without that, other goods have still, again, you see how broad some of these increases are in the top line contributions, which again is why we're going to see the Fed do what it's going to do, but also why the consumer doesn't have the same type of the discretionary income to go out and spend. U.S. wages and salaries were up 0.8% in July, strongest month-over-month gain since February of 2022. But even with that increase, you still have a negative real number. To give you an idea on, again, that strength of inflation and that impact, which is only continuing as we continue to see money get taken out from savings. Like savings rates, it's the lowest it's been since 2009. We're at 5% because people don't have the discretionary income to save because they have to spend. Even though their wages have gone up, they still have to spend to maintain lifestyle. And that's, again, pulling more out of savings. PC inflation declined for the first time since April 2020 to be negative 0.1 versus 0%. Core was up 0.1 versus 0.2%, but this is more of a deceleration. It's not that it's stopped. There was a small decline, on the top line number, but on the core number, it still went up. Again, slower, rate of change paused, but still moving in the wrong direction and still remaining at elevated levels, which is what they're looking at. Now, I thought this was an interesting chart because market prices are a poor predictor of inflation. And I always think it's fun when you look at, put those plots out there and you can see how it's not a great, view. It's not like Leo, which I think is hysterical, Leo DiCaprio's ability to maintain a girlfriend that's older than 25, which is spot on. This is not. And again, this is where you see some of those inflation things and the impacts, which is why it's hard to say, well, this is showing deflation, so we should buy TLT. We don't see that the same way. And then when you start looking at what do you expect core CPI to be in December of 2023, the respondents still have us above 3%. And you can see if you go back in time how everyone thought it was transitory. They all bought in. Then it was a little less transitory. Then it was like, oh, this is longer for higher for longer. Oh, and that's where I think you're going to continue to see that creep and that bell curve really shift and really get towards that elevated level and remain well above. Because even if we had 0% inflation heading into the end of the year, I mean, I should say 0% rate of change, we're still at 6%. So again, there's a lot of wood to chop as we go forward. And then when you look at one reason current slowdown differs from other mid-cycle slowdowns is that CPI out year over year is outpacing year over year change in leading economic index. Current spread historically consistent with recessions. So again, you're getting more of these feelings and these problems where we're going to continue to drift down into that slowdown. So far, the surge in interest rates in advanced economies has not made much of an impact on private sector finances. And I think that's going to be the important piece because a lot of people were able to lock in rates on mortgages, everything else at a favorable rate. So then if they have the spare income, and when you look at private lending, the rates are still competitive, even though the Fed has gone back up. The question will be, when does that start to break, and when do we see rates starting to pivot a bit higher? And that's also going to compress the margins. So all regional Fed surveys, unfilled orders and supplier deliveries, PPI trade services, the survey data advanced 9 months. And the question is now going to be, where does that end out? So I still think that there's some staying power in the PPI, given some of the different pieces, given some of the different issues that we're seeing in the market for demand. But when you look at input costs, they're still elevated. And that's where we see a little bit of a disconnect. And if you look at 18 through essentially the end of 19, you can see that there was that disconnect between Fed surveys and PPI trade services, and that was at the trade war. But I actually think you could see a flip where PPI trade services stay expensive in comparison to what the Fed regional pieces are saying. And that's when you start looking at, well, who expects workers to stop getting raises without a recession? And you can see that a lot of people still expect, the percentage of workers receiving no wage increase is still low. So again, coming back to the wage spiral and that PPI, those input costs still are, have that backdrop, have that support and that tailwind. Now, job postings on Indeed have started to slow, but they're still elevated. They're still high. So there still is some of that job creativity out there. But then when you look at the CEO confidence survey, CEO confidence firmly in recessionary has plunged so far in the third quarter, now lower than pandemic trough and at the same level as in the third quarter of 2019. And here's one of the key reasons why. 40% of small and medium businesses couldn't afford August rent. That's up 6%. So per the survey, 40% of small businesses said they could not pay their rent in full this month, up 6% month over month, setting a record for 2022. Again, there's that problem where the input costs are going higher. We're going to talk more about rent in the next segment. But again, these are the input costs that have to be passed on, and they're struggling to pass them on, which is why they couldn't afford them. So that means that you either have to raise prices or cut prices a bit, but try to make up volume. And again, this is where these input costs continue to be sticky. Credit and debit card spending at U.S. retailers changed from 1 year earlier. Discount and dollar stores are picking it up because people, again, want to maintain lifestyle, but will go for the cheaper option. And these are where the alternatives, but as you can see, the department stores turn down again, but discount and dollar stores are staying flat. And so again, that it's just showing that you're getting a drop in terms of total spending, even though things are still remaining elevated at the discount and dollar side. July retail inventories were up 1.1% versus the estimate of 1.2%. So again, you're still seeing inventories remaining elevated. So this is where, when we're seeing what are job cuts going to do, or are we going to see sales? This is some of those overhangs that we're talking about. Goods trade deficit continued to narrow, $89.1 billion in July versus the estimate of $98.5. Strong dollar. Imports were cheaper in terms of value. Exports, we had a backlog of exports. So again, this has been able to stay fairly elevated. Obviously, still negative. We're net importers, but still better than where it has been. But then when you look at savings, personal saving rate was unchanged in July at 5%, still hovering near the lowest since the great financial crisis. And again, as we said, since 2009. And we think it takes another leg down, and not that it's going to go negative, because it's going to be hard to go negative, but you're seeing that people are still struggling to squirrel away that money. Now, when you start looking at openings that continue to outpace the number of unemployed, about 2 jobs for every unemployed person, up from 1.9, but the July quit rate edged down a bit. So again, you're still seeing jobs, you're still seeing those jolts, But quit rates are slowing because people are starting to see a little bit of a problem trying to get a new job. And we actually have a survey on that in a moment. So U.S. job opening rates, unexpected increase in July JOLTS contributed to a stall in convergence between services and goods, though for sector like leisure, openings remain well off of peak. So again, you're still seeing the slowdown, but nothing goes down in a straight line. Typically nothing goes up in a straight line. So as you get this slowdown, that's again going to weigh further on where some of the things sit. And again, some of that downward move, we saw 3M cutting jobs. So here, Challenger job cut announcements, August job cut announcements, 30.3% up 30.3% year on year versus 36.3% in the prior month. Third consecutive increase with the tech sector leading all industries with 5,081 cuts in August. So far this year, tech companies have announced 14,408 cuts. 3M just announced more. Credit Suisse just announced more. So again, you're starting to see those cuts come through, and that's going to slow down a lot of these different pieces. But the beverage curve is showing you just how elevated we are in terms of where job openings are versus unemployment rate. And you can see the disconnect versus historics. And that's where so even though we still have this situation, you're still seeing this inability or these a large amount of job openings. But yet, when you talk to people, from great resignation to great regret, so 40% so reasons why U.S. workers who quit their previous job regret their decision, 40% harder than expected to find a new job. So this is where it gets interesting, because even though the job openings are there, are they real or will they get filled? And what does that mean? It means, was there a hiring freeze? Did the job go away and get absorbed? And we're starting to see, again, some of these pivots that remain in the system. So even though it looks like there's a lot of jobs, it's getting, again, harder to kind of find those jobs. And I think that's the disconnect that we see. Now, given, people may also, harder than expected. Are you asking for too much money? Are you pricing yourself out? Do you want a title that you really haven't earned? So again, there's a push and pull here. I'm not saying it's all on the corporate side. There's a certain amount of how much give is the person looking to get, but how much give is the person looking to offer up? And again, that's where that balancing act, because they're looking at the numbers and say, well, there's a lot of jobs. It's like, yeah, but you're asking for too much. So I think that's going to have to kind of be that meet in the middle. So in the next segment now, we're going to go deeper into some of the positives that have come out, and then where some of the leading indicators are pointing us as we head, September begins. Welcome to September, and we progress through the end of Q3.